Every time you send a text message, stream a video, or hail a ride on your phone, there is a very high probability you are paying a toll to one specific digital landlord. AT&T operates a massive, invisible toll road across the United States. It commands a network of 120 million mobile connections and over 10 million homes wired with high-speed fiber optics, generating $125 billion in revenue every single year. After spinning off its messy entertainment acquisitions, like Time Warner and DirecTV, AT&T has stripped itself down to a single function. It is now the foundational landlord of American connectivity, collecting rent on almost every digital action we take. Yet, despite this guaranteed avalanche of recurring cash, Wall Street treats the company with extreme caution. The stock trades at a deep discount to the broader market, hovering around an 8 to 10 price-to-earnings ratio. This chart shows the primary anchor dragging down that valuation. AT&T carries a staggering $138 billion in total debt. As older bonds mature in today's high-interest rate environment, refinancing this mountain of debt is becoming increasingly expensive. So how does a near monopoly that clears $125 billion a year struggle to grow its market value, while simultaneously choking on debt? The answer starts with the unique structure of the U.S. telecom market. AT&T operates in a rational oligopoly alongside Verizon and T-Mobile. Tech startups cannot simply write some code and launch a competing app. They have to physically build a nationwide network from scratch. That physical entry fee is astronomical. In mid-2026, AT&T spent $23 billion to acquire invisible wireless spectrum licenses from EchoStar, and another $5.75 billion buying physical fiber optic trenches from Lumen. Once AT&T connects a household to that physical fiber, they bundle it with a mobile 5G plan, a strategy called convergence. When a customer relies on a single provider for both home internet and mobile data, cancellation rates drop nearly to zero. The combination of government-licensed airwaves, thousands of miles of physical glass in the ground, and highly sticky bundled customers creates an economic moat that is virtually impossible to cross without hundreds of billions of dollars in upfront capital. But that protective moat comes with a punishing structural flaw known as the capital expenditure treadmill. A physical concrete toll bridge can stand for decades with only minor repairs. A digital network cannot. To stop subscribers from defecting to rivals, operators have to constantly rip out old hardware and install new technology, transitioning from 4G to 5G and eventually to 6G. Because of this forced, relentless upgrade cycle, AT&T has to spend between $23 and $24 billion in capital expenditures every single year just to maintain its network quality and keep its current market share. Inside the company, another massive expense is quietly draining resources, the ancient copper telephone network. Maintaining these decaying wires cost AT&T roughly $4 to $6 billion annually. It is a highly inefficient, power-hungry system that serves a customer base that shrinks every single quarter. Fighting a two-front war against a $138 billion debt load on one side and a rotting copper network on the other severely limits the cash AT&T can deploy toward its high-speed, modern future. If you look at standard Wall Street metrics like net income, the financial picture of a telecom company is heavily distorted. They carry massive non-cash depreciation charges tied to all that aging network equipment. This flowchart shows how that $125 billion in revenue actually filters downward. After you subtract the money spent running on the Capex treadmill and the cash burned on debt interest, you get to the only metric that actually matters: free cash flow. Despite those enormous expenses, the digital toll road still clears a baseline of $18 billion in pure, real free cash flow every year. That $18 billion is the ultimate lifeline of the company. It is the only hard cash available to chip away at the debt mountain and pay out dividends to the equity shareholders. Management is executing an aggressive escape plan to free up more of that cash. Their strategy relies on rapidly shutting down the legacy copper network and moving those remaining customers onto efficient fiber optic lines. Historically, complex local regulations slowed this process to a crawl. But a March 2026 mandate from the FCC, led by Chairman Brendan Carr, stripped away bureaucratic red tape, giving AT&T the federal authority to finally execute this copper sunset. Even with the copper shutdown accelerating, AT&T faces serious external threats. On the ground, cable operators like Comcast are using aggressive bundling tactics to siphon away budget-conscious mobile users. From above, low Earth orbit satellite networks like SpaceX's Starlink are racing to beam connectivity directly to smartphones, threatening to bypass traditional cell towers entirely. The company is locked in a high-stakes race today, desperately modernizing its infrastructure and trimming its legacy costs before nimble cable competitors or space-based networks can render its physical moat obsolete. For an investor looking at the company today, AT&T is no longer a high-growth technology stock. It operates as a highly leveraged, slow-moving utility. At roughly $25 a share, the stock offers a relatively safe 4.4% dividend yield. That dividend is deeply insulated, consuming only about 43% of the company's annual free cash flow. Buying AT&T isn't a bet on explosive innovation or rapid market expansion. It is a calculated wager that the digital toll road can generate cash fast enough to outrun the punishing demands of the capital expenditure treadmill and the heavy weight of high interest rates.